Good day, fellow investors. I've got a lot of questions on, okay, Sven, Intel, now it's down. You explained in this video why it is down, but is it now a buy? Or perhaps even the better question to answer here, is it a sell? Let's analyze again that investment perspective, the risk and reward of Intel now, and then put it into a perspective to your portfolio where we compare to other options and to the strategy of a portfolio. Let's start. We have discussed Intel 2 weeks ago. Thank you for the 59,000 views. And we also discussed it a few months ago where I told you to go to 20. Now we are at 20. And I want to discuss this now because there were so many comments, especially a lot of negative comments, which then turns your mind into thinking the best buys are made when there is blood on the streets, and there is definitely blood on the streets now on Intel. About 95% of the comments on Intel were very negative, and perhaps this one summarizes it all. When it drops to 1, that's the time to buy. It was about competition, about management, about simply not reaching that profitability, investing wrongly. So a lot of negative comments, but there were also some positive comments, because even if the price has stabilized now, whenever someone is selling, someone is also buying. And for example, Richard K here bought because it's a too big to fail company. That's correct. Will likely produce, but the ownership might change, and it's part of the national security. Of course, if there is something going on with Taiwan chips and everything, then this will triple because it will be the only supply chain possible. Intel has the foundries, other companies do not, they outsource. So everything is very expensive, not to mention construction costs. There are, of course, problems. That is why we see that price. I'm going to give them some time. I might be wrong, but 25% down seemed an overreaction. And that national security, as were there in comments, is the only realistic scenario. But as they say, the founder will be handed over to better management, investors, debt owners. So we are now here where we are. And with Intel, if things turn positive, there has been a 90% jump from the 3rd of March to 29 December 2023. That was just a few months ago. So this can happen again easily if there is just a few quarters of good news, some improved competitivity, margins, etc. But when it comes to buying something like this or holding, then you ask yourself, okay, from a value investment perspective, is there a margin of safety? The market cap is 90 billion, so I go to the balance sheet and I look for what is the book value, what is the value of all these platforms and everything, and I find here total stockholders equity 120 billion. And then I say, okay, I'm buying something of 120 billion for 90 billion, that's already a margin of safety and should be okay. However, or I'm not selling because the value is there and I will be rewarded at some point in time. But then I went to dig a little bit deeper, and the first thing is there were no profits, and the equity jumped from 109 billion to 120. So there was an increase of almost 11 billion in equity on no profits. How is that possible? I went to look at what's going on here, and they have cash that went up by 4 billion, and they have some property, plant and equipment that went up. But I looked at the liabilities, at the debt went up. So how it is possible that equity goes up if the company is not profitable? Retained earnings went down 3 billion, and you see here equity went up. Well, they have here an increase of equity of plus 13 billion, but then you think they have issued stocks. But if you look at the issued stock and outstanding, they have issued just, what is this, 50 million? That's nothing of stocks, that's just for compensation. How is this possible that they are increasing equity without issuing stocks? Well, here you have the deal. They are going to do joint ventures related to their Fab 34 in Ireland, and Apollo will acquire for 11 billion the equity interest in the joint venture related to Intel's fab. Intel has already invested for 18 billion into that, and now Apollo is acquiring a segment of that for 11 billion. And then if I read a little bit deeper, they are keeping the controlling interest, will retain full ownership of the operational control, and the transaction is designed to enhance the company's strong balance sheet with capital at cost below Intel's cost of equity. The investment in the joint venture is expected to be treated as equity-like form from a ratings perspective. So will be treated as equity, but actually it will be a loan at lower of Intel cost of equity. And if you look here at the transaction details, they will just consolidate the results of the joint venture through net income and account for net income in the non-controlling interest. So they will not show this as a liability because that's part of their smart capital approach. Another financial shenanigan from Intel that is in line with the accounting fraud that we already discussed a year ago, where they simply changed their accounting rules to make them look at least profitable for a while, because their machines are suddenly worth more while making no profits. Well, that's the past, and they are just doing financial shenanigans over time. So now I'm asking myself, is Intel the next Enron? They are doing things in that line, and unfortunately, the more I dig into Intel, the more it looks ugly, ugly, and ugly. Well, this is it, and just because it's non-controlling interest, they are not issuing shares, but they have given away those 11 billions of there is some liability, and you will now see what kind of liability there is. Plus, let's dig deeper. There is goodwill, 27 billion. They have created that goodwill by acquiring Altera in 2015 for 16 billion and Mobileye in 2017 for 15 billion. So there you have your 40 billion of goodwill. After 10 and 7 years, those businesses are not even profitable, have declining revenues. So I don't know, they are trying to do an IPO with this, but I don't know whether this will be worth the 27 billion, not to mention all the money they have invested into that over time. Now, if we go towards the equity, 120, minus 25 of goodwill, minus 25 billion of crazy accounting, minus the discount on the property, plant, and equipment. If we go to the old accounting, we are at book value perhaps of 70 billion compared to a market cap of 90 billion. So we are still not at book value safety. And then if I go back to the Apollo transaction, just look at this. Under the agreement, the joint venture will have rights to manufacture wafers to support long-term demand for Intel's products and provide capacity for Inter-foundry customers. Intel will have the controlling interest, retain full ownership. However, the joint venture will manufacture wafers for sale to Intel on a cost-plus margin basis. So Apollo did not invest into the foundry, they didn't invest into anything. They invested 11 billion, and they just know that Intel has minimum volume commitments. So worst case scenario, we have this volume plus the margin. This is the margin we get, and we get a return of 11% that Apollo wants from their investment. And that's it. They are not investing into Intel, they are investing into something Intel will have to do no matter what. They have minimum volume commitments, so it's just a bond for Apollo with unlimited upside depending on what they are producing, how much over time, and absolutely no downside. This is financial shenanigans, so I'm taking again another 20 billion out of the equity, because if you look at their equity, it has been just going up from 25 billion to 49 billion, so that's actually minus 25 billion without them issuing too many shares. So that's crazy accounting. The value of Intel's book value is maybe 50 billion if I dig deep into it. So unfortunately, there is no margin of safety. Nevertheless, let's discuss the strategy. So if turnarounds, cyclicals are your thing, then yes, Intel, if the turnarounds, then you start becoming a specialist. You have probably 20 positions in these portfolios. You know how to manage those turnarounds. You know how to manage the 50%, 30% weekly declines if those happens. So it's a lot of work, but if that is your strategy, then yes, Intel is a hold from that perspective. From a portfolio perspective, the question is there something better? Warren Buffett is selling Apple to buy US treasuries. So when it comes to answering Alberto's question, I think that from a value investing perspective, I know that it has been ugly, but I would consider Intel a sell. Of course, anything can happen. Intel can be a plus 100% in the next 12 months if something happens in China, if things improve. That is always a risk. But from a clear mind, not anchoring the situation to the price you paid, wait for a partial recovery to recoup some of that money. That's anchoring, that's pure behavioral finance. I would not consider Intel a thing to play now with, unfortunately. So again, going back, see whether you have something better and something that fits your strategy. Those are the key answers you have to find yourself. If you enjoy my thinking, subscribe, check what I do, and I'll see you in the next video.